This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Friday, July 10, 2026, and this is the New York session. Now, let's get into it. Extreme fear. That is the headline from the street, where the fear and greed index has plummeted to a stark 14 out of 100. Yet, look closer at the dollar. The DXY isn't surging. Instead, we see a strange divergence. Gold is holding near its 5-day high, and the British pound is pushing upward. We are standing on the edge of a knife, caught between a higher for longer rate narrative and a market that refuses to chase yield. Let's look at the map. On the calendar, the market is frozen. The big one is the July 14th U.S. Consumer Price Index report, 4 days away. Everything from the Bank of Canada's rate decision on the 15th to the ECB's meeting on the 16th is being priced in quiet anticipation of that inflation print. There is no room for error. A miss or a beat on that Tuesday CPI date will dictate the trajectory for every single cross rate in this book. Apex, help me understand what we're seeing in the noise right now.
You're looking at a paralysis of conviction. The director's brief highlights a critical dissonance. The fear index is at 14, screaming risk off, yet the trade-weighted dollar index is down 0.46% week over week. Why aren't buyers flocking to the greenback en masse? It's because the 10-year yield is stuck at 4.56% and the curve is flat. The market has accepted the 3.62% Fed funds rate as the new baseline. The dollar isn't weak, it's just fully valued. Meanwhile, we see selective strength in the Kiwi and the Aussie, driven by specific fund flows that defy the broader risk-off mood. It's a fragmented picture.
Let's get into the headlines moving the needle. First, the Canadian economy. The June employment report came in hot at plus 18. 2K jobs versus 10K expected, yet building permits fell minus 1.7%. Pulse, how does this data impact the broader currency landscape? It's creating a massive decoupling event for the loonie. Normally, strong jobs data supports the Canadian dollar and pushes dollar CAD lower. But here, dollar CAD is at 1.4149, only down 0.13%, which feels sluggish given the non-farm payrolls beat. The Bank of Canada is getting a clear mandate to maintain restrictive policy. They don't need to cut because the labor market is too tight. This keeps the Canadian dollar insulated from the general dollar strength narrative, effectively removing Canadian dollar from the list of currencies vulnerable to a broad dollar rally. Second headline, the dollar is mostly lower, led by the dollar yen. And third, the fear and greed index is at 14. Grid, let's look at the charts. Where is the pain? Where is the opportunity?
The pain is in the compression. Look at euro-dollar. It is sitting at 1.1448, practically touching its 5-day high of 1.14609. We are in a box. The range is 1.13912 to 1.14609. This is a coiled spring. On the flip side, dollar-yen has dropped 0.51% to 161.547. It is dangerously close to its 5-day low of 161.287. The bears are testing the floor. If 161.287 breaks, we don't just get a technical break, we get a liquidity grab. Meanwhile, cable is at 1.3438, breaking above its own recent consolidation, showing relative strength that euro-dollar simply doesn't have right now.
CIPHER, let's talk flows. You see the positioning behind these moves. Why is the yen taking the hit, and why is the Aussie holding up?
Because the yen shorts are grotesquely crowded, leveraged funds hold a net short position of negative 115,400 contracts in yen. That is a weekly increase of negative 117,107 contracts. It's a suicide pact waiting for a spark. Conversely, look at the Aussie. Leveraged funds are net long plus 31,777 contracts. This explains why Aussie dollar is up 0.24% to 0.6959, despite the fear. The speculators are betting on commodity resilience, not safety. In contrast, Canadian dollar is still net short negative 88,101 by leveraged funds. So you have funds shorting Canadian dollar despite the jobs beat and crushing yen positions while quietly building RC longs. It's an uneven distribution of risk.
SPECTER, this sounds risky. Are we setting ourselves up for a blow-up?
Absolutely. The VIX is at 16.9, which seems calm, but remember, it's sitting in the lower half of its 5-day range of 15.53 to 18.91. Low volatility in a fearful market is not safety, it's compression. When you combine a VIX compression with a negative 115,400 net yen short, you have a structural flaw. If dollar-yen breaks 161.287, those shorts don't exit gracefully. They get stopped out mechanically. That creates a liquidity vacuum. The danger isn't just a drop in yen. It's a spike in volatility that invalidates all the tidy technical setups Grid mentioned. The market is bracing for a shock, not a drift.
Let's dive into the specifics. Starting with the big one, euro-dollar. It's at 1.1448. Grid, you've got the levels. What happens next?
It's binary. We are 0.00125 below the 1.14609 resistance. A break above that level clears the board. There is no immediate resistance left, but currently the structure is neutral to bearish for the dollar because of the dollar-yen weakness. However, without volume expansion, this is a coil. The lack of volume tells us we are in a wait-and-see mode. The path of least resistance is a squeeze. But we need a catalyst to trigger the explosion out of the 1.13912 to 1.14609 range.
And the funding is working against you, Grid. The leveraged funds have dropped their euro net position by negative 32,395 contracts this week. You're talking about a breakout based on technicals, but the actual speculators are selling the euro. The long side support is vanishing. You are asking retail to buy into a wall that institutions are trying to dismantle.
That's why the 1.14609 level is critical. If it holds, the euro longs get squeezed. But if the yen shorts unwind, as CIPHER suggested, that capital flows somewhere. It doesn't necessarily go into euro, it goes into commodities, which brings us to cable.
Cable, it's at 1.3438. Pulse, why is sterling stronger than the euro right now?
Relative value. The UK data is sticky, similar to the US, but the Bank of England is perceived as being further ahead in the cycle than the ECB. The ECB faces questions about whether they need one more hike, but the market is skeptical. Meanwhile, the pound is benefiting from a general risk-off rotation, where traders are abandoning the eurozone peripheral risks and parking money in pound as a secondary dollar hedge. It's not a bull market for pound. It's just less bearish than euro.
CIPHER, what's happening in the gilt flows?
Asset managers are still net short pound, but the speed of the shorting has slowed. The aggressive liquidation phase appears to be pausing. However, the net position is still negative. The current uptick in cable is driven by spot demand and carry trades, not institutional conviction. It's a fragile rise.
Let's move to dollar-yen. It's at 161.547. Grid, you mentioned the 161.287 low. Is this a breakdown or a bounce?
It is a test. The 5-day range is 161.287 to 162.71. We are currently at 161.547. We are essentially at the basement door. The bears are knocking. If 161.287 breaks, we enter uncharted territory below the 5-day low. Technically, this is a breakdown of the short-term uptrend that started earlier in the month. The lower highs are evident. We failed to hold 162.71 last week. Now we are testing the lowest point of the last 5 sessions. A break here confirms the bearish momentum.
But Grid, you're ignoring the gravity of that short position. Negative 115,400 contracts. That is not just bearish momentum, that is a loaded gun. If 161.287 breaks, you won't see a smooth drift lower, you will see a gap. The algorithmic covering of those shorts will create vertical liquidity. The technical breakdown and the fundamental squeeze will happen simultaneously. It will be violent.
And don't forget the Bank of Japan. They are set to keep rates unchanged at the July meeting, maintaining their tightening guidance. They are not intervening verbally right now, which gives the sellers cover. But if the BOJ hints at further tightening, that negative 115,400 position becomes untenable overnight. The macro backdrop supports the short, but the positioning makes it unsustainable.
Gold, it's at 4,118.56. SPECTER, you flagged this earlier. Why is gold holding near its highs when stocks are scared?
Because the DXY is lying. The dollar isn't weak fundamentally, but it isn't rallying either. When you have a fear index of 14, you expect a rush to cash. But the cash isn't flowing into dollar because of the yield curve flattening. The 10-year 2-year spread is flat at 0.38. The market knows the Fed is capped at 3.62%. So where does the fear go? Into gold. Gold is at 4,118.56, approaching the 5-day high of 4,203.23. This is a divergence. Smart money is using gold as the hedge against the inflation stickiness, 4.17% CPI, rather than holding dollar. It's a sophisticated play. They know the Fed can't fix inflation, so they buy the real asset.
Aussie dollar, it's at 0.6959. CIPHER, you mentioned the leveraged funds are long. Is this sustainable?
Only as long as risk appetite doesn't completely evaporate. Positive 31,777 net longs in Aussie is a huge bet on commodity prices and global growth. If the fear index drops lower, if the VIX spikes, those longs will be the first to dump. Aussie is a beta play. It works when everyone is greedy. Right now, we are fearful. The fact that Aussie is still up 0.24% is remarkable, but it's relying on the assumption that the fear is overstated. If the CPI comes in hot and the market realizes growth is slowing, those Aussie longs will vanish instantly.
Exactly. The Canadian employment data helped Canadian dollar, but Aussie has no such recent fundamental tailwind. It's purely speculative. The divergence between the Aussie longs and the Swiss franc shorts is telling. Everyone is long risk Aussie and short safety Swiss franc. It's a concentrated trade. If the CPI report suggests stagflation, that's your worst case scenario. You get crushed on both sides. You lose on the yield and you lose on the growth.
Dollar CAD, it's at 1.4149. Grid, what's the technical setup here given the mixed Canadian data?
Dollar CAD is in a 5-day range of 1.41359 to 1.42389. It's currently at 1.4149 near the bottom of that range. The 0.13% decline is modest, but structurally it's refusing to break higher despite the weak dollar. The support at 1.41359 is hard. The jobs data created a floor here. Even though leveraged funds are short Canadian dollar, the spot market is absorbing the sells. If 1.41359 breaks, we drop quickly, but for now, it's holding. It's a defense zone.
Remember, those funds are short Canadian dollar by negative 88,101. They are betting against the very jobs data that is supporting the price. This is a classic positioning trap. The fundamentals, jobs, are saying buy Canadian dollar, but the flows, funds, are saying sell Canadian dollar. When you have a contradiction between spot price action and COT positioning, the spot price usually wins in the short term. The funds are late to the party. They will eventually have to cover.
Finally, let's touch on the broader context. The fear and greed is at 14, VIX at 16.9. Apex, tie this together. What is the overarching theme for this pre-CPI silence?
The theme is asymmetry. We have extreme fear, 14/100, but contained volatility, VIX 16.9. This means the market is afraid, but it isn't panicking yet. It's waiting. The asymmetry lies in the dollar-yen short squeeze. Grid identified the 161.287 technical level. CIPHER identified the negative 115,400 contractual liability. Pulse identified the BOJ guidance. SPECTER warned of the volatility shark. All roads lead to that one level. If 161.287 holds, the status quo remains. Euro-dollar squeezes upward toward 1.14609 and cable grinds higher. But if 161.287 breaks, the mechanical cover of those yen shorts will lift the dollar abruptly, reversing the gains in pound and euro instantly. The market is not trending, it's loading. The CPI on the 14th provides the ammunition, but the technical breakdown in yen provides the fuse.
So, our takeaway. Euro-dollar is coiling near 1.14609. Dollar-yen is teetering on the edge of 161.287 with catastrophic positioning behind it, and gold is acting as the true safe haven as the dollar stalls. Watch the 141.49 level in dollar CAD for defense and monitor the VIX for that spring-loaded snap. That is your map for Friday. We'll see you on the other side of the CPI. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex Edition. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.